Hello and welcome to the weekly wrap video. Just a couple of things to catch you up on then. From the past 5 trading sessions, it's been a story of US growth with 2 real flashpoints for this theory this week, the first of which being the final reading for Q1 GDP in the US, which was revised markedly lower, down to minus 2.9%, the worst period of contraction for the US economy since the depths of the financial crisis some years ago. So a lot of this theory was originally put on the very, very poor and adverse weather we saw in the first quarter, but a lot of this now coming from Obamacare, as the US President's policies on healthcare really do not follow through into economic growth for the economy. Has also dampened a lot of analyst expectations for a bounce back in Q2, as personal income and spending data on Thursday showed the highest savings rate for the US individual since September of last year. So those hoping for a return of the US consumer may be disappointed when Q2 GDP rolls around in around a month's time. As such, stock markets did sustain losses, which was exacerbated by comments out of Fed's Bullard, who said that rate rises could come in the first quarter of 2015. That is actually slightly faster than the market currently expects, which did prompt some further downside in stocks, as they did react with caution that the Federal Reserve could potentially be hiking rates sooner than they previously thought. Elsewhere, in terms of central bank news, we had the Bank of England Financial Stability Report, and this biannual report unveiled some measures to somewhat temper the housing market in order to avoid any bubble-like conditions that could trouble the economic recovery in the UK in the coming months. Now, this was seen as actually a slightly softer touch than expected, as the loan-to-income ratio of just 4.5 and the 80% cap on high-risk mortgages was seen as not enough to deter home building and an increase in house prices in the UK. As such, did see a lot of upside in the likes of home building and construction stocks in the UK, as well as mortgage lenders, with the likes of Lloyds Banking Group rallying pretty firmly in the wake of the announcements. In terms of monetary policy then, this is also seen not standing in the way for the Monetary Policy Committee to commence their rate tightening cycle, of which Mark Carney just on Friday in an interview with the BBC did say that the first hike could occur even in 2014, if not 2015. One final thing worth noting this week, a lot of eyes had of course been on the geopolitical tensions in the Middle East and eastern Ukraine. Now these have slightly dissipated this week, with Brent crude on path for its worst week since March. Now this is as the Libyan production comes back online after a series of protests at the Hariga port, as well as a continued expectation that the ISIS militants over in Iraq will fail to reach Basra, the southern port through which 100% of Iraq's oil exports are currently passed through. Quick look ahead to next week then. It's likely to be a busy one, although slightly truncated, as we have Independence Day in the US on Friday, so that July the 4th will see all the US markets closed. As such, non-farm payrolls has been brought forward. We had that on Thursday alongside the ECB rate decision and press conference, US trade balance, as well as weekly jobs data. So all of that at the same time. That's 1:30 London on Thursday, 7:30 in Chicago. We'll bring you all those releases as soon as they hit the wires, as well as any other relevant commentary to your trading. But in the meantime, that's all from me. Have a fantastic weekend.